Welcome to the WTR Small-Cap Spotlight podcast. I'm your host, Tim Gerdeman, Vice Chair and Co-founder and Chief Marketing Officer of Water Tower Research. In today's podcast episode, I'm being joined by Shahin Amini, Head of Investor Relations and Communications for Meren Energy, Toronto Stock Exchange, ticker symbol MER. Meren, incorporated in British Columbia, is an independent full-cycle exploration and production company with production and development assets in deepwater Nigeria, a leading carried position in the Orange Basin across Namibia and South Africa, and operated licenses in Equatorial Guinea. Also joining is my WTR equity research colleague, Jeff Robertson. Good morning, gentlemen, and thank you for joining today's podcast.
Good
Thanks,
morning,
Tim. Thanks for having us.
Shahin, Meren recently rebranded the company from its previous namesake, Africa Oil Corporation. Can you please provide some background that led to the rebranding and also speak to how Meren's capital allocation framework seeks to deliver value to its stakeholders?
Absolutely, Tim. We rebranded the company following a transformational deal that was completed earlier this year. Through this deal, we doubled our reserves and production. As a quick historical context, we originally had acquired a 50% interest in a joint venture company called Prime Oil and Gas in January 2020. And through the deal that we completed earlier this year, we have now fully consolidated Prime into Meren Energy. Now, previously we were called Africa Oil Corp. And we really, the executive team and the board felt that the completion of the deal was a good milestone in the company's history. So we had the coming together of Prime and Old Africa Oil. So that was a good opportunity for us to rebrand the combined entity. But there was also a couple of practical considerations as well. So we had oil in our name, and we also have natural gas assets and natural gas opportunities. So Africa Oil was a bit limiting from that perspective. And also there was still quite a lot of shareholders and investors in the capital markets that still viewed the Old Africa Oil as a junior exploration company. And really, we have come a long way from those early days as a pioneering explorer in East Africa. And, primarily through this Prime acquisition, we have transformed into a full cycle E&P company. And since 2020, we've returned more than $400 million to our shareholders through base dividend share buybacks. So we have matured as a business. And we just felt that it was important for us to complete the rebrand to mark that milestone as well. And to your second part of your question about our capital allocation framework, that's really at the heart of what we do every day. Since we completed the Prime acquisition, we have demonstrated our ability through cash flows that we have from our high-class assets in Nigeria to support and sustain our growth opportunities in Nigeria and other jurisdictions, but also, as I've already mentioned, return considerable amounts of money to our shareholders. Now, our priority is to defend our balance sheet. We have a very strong balance sheet. If anything, we are actually under leveraged. Our last reported net debt to EBITDA was 0.6 times. And we want to maintain significant liquidity that is pragmatic through the business cycle. So we want to be in a position that we can continue delivering organic growth and shareholder returns without stretching the balance sheet.
That's great. We're actually clearly moving into a market where balance sheets are being scrutinized. So it sounds like you're in a great position. Before I turn it over to Jeff, our listeners always like to hear about the backgrounds of our speakers. So if you could just give us kind of a 30,000-foot overview of your professional background, please.
Yeah, of course. Very briefly, I started in the industry as an engineer. I was an offshore subsea engineer. And one thing and another led to me changing path. I got into the capital markets. I was a project financier for a while. And then I ultimately ended up as a sell-side analyst. And I actually covered the Old Africa Oil, what is now known as Meren, as a sell-side analyst. And I must have done a good enough job because the former CEO offered me a job. I've been with the company for 6 years now, and it's been a fantastic 6 years as we have grown considerably.
That is a perfect background for your current role. So with that, I will turn it over to Jeff Robertson to ask a few questions.
Thanks, Tim. Shahin, before we jump into the assets, I just want to to talk about production sharing agreements, which drive the economics of Meren's positions in Nigeria and the other areas that the company owns assets in. Can you just give a high-level take for someone who may not be familiar with that type of structure, how those PSAs impact entitlement production as oil prices move both up and down?
Absolutely, Jeff. Production sharing contracts, or in our case, production sharing agreements, are very common frameworks for oil and gas exploration and production around the world, but especially in emerging markets. So these are very common commercial frameworks in Nigeria, for example. And the basic idea is that the local concessionaire awards the contract to the international oil and gas companies in order to attract expertise and capital for exploration, and in case of successful discovery, through development and production phases of a project. So the companies really foot the bill up front. Now, if the project is successful and from an exploration perspective, let's say we have a commercial discovery, there's a development, and then production starts, and then the revenues are split according to the production sharing agreement or contract terms. The company typically first gets to recover its costs, and that is called the cost oil pool. And what is left after that recovery phase is what we have the profit oil pool, and that is shared between the company and the concessionaire as per negotiated formulas. Now, typically the concessionaires in these agreements are the host governments, but in our case, we have two indigenous companies that act as the concessionaires. And the reason for that is because in the 1990s, they actually won the right from the government to explore these licenses. They subsequently then brought in the international oil and gas company as partners to explore and subsequently to foot the cost for developments. And look, from a practical point of view, the interest that we have in the PSAs, and this is a very positive for us, is that because we are recovering our costs, if the oil price goes down, our entitlement goes up. And that, in a sense, gives us a natural hedge in our assets. Now, from a practical point of view, in terms of our reporting to the markets, we report both a working interest production and an entitlement production. Why do we do that? Working interest is important for analysts and investors because they want to know how the assets are performing. And that is simply the gross field numbers multiplied by our interest in the licenses. Entitlement, on the other hand, is what we get through the production sharing contracts agreements, and that drives the revenues, right? So as a company, we report both numbers. The entitlement is typically larger because we have that cost recovery mechanism built into it.
I'd like to shift to the assets. As you mentioned, Africa Oil's legacy was an Africa-focused exploration company. The company acquired its interest in Nigeria, a 50% interest in offshore deepwater Nigeria in 2020. Shahin, what drew the company to Nigeria at that time?
Well, very simply, it's the scale and the quality of the opportunities. And Nigeria, like many other countries on the African continent, do offer world-class petroleum geology. And in Nigeria, we had an array of opportunities, in front of us. And what really attracted us to the deepwater opportunity set was, again, the size of the fields. And we have 3 producing fields, Agbami, Egina, and Akpo. And, these were transformational for us, for our portfolio, for our shareholders. But these are assets of a scale that are also strategic and material for our partners. And our operating partners on these assets on Agbami is Chevron, and on the other 2, Akpo and Egina, is TotalEnergies. These assets are also material to them. So even though we are a relatively small independent exploration and production company, the assets that we do are big oil company assets. So each one of these fields at its peak would have produced more than 200,000 barrels of oil per day. And these are very high quality midlife assets that are generating significant cash flows. And I've mentioned Chevron, TotalEnergies. I'm sure most of the people listening to this podcast would appreciate that these are companies with significant resources and expertise. So it is very good to be partnered with these companies in these fields, which are really, truly world class. There's also in Nigeria, I think, and I think we have a job to do as well. I think there's a lot of caution around Nigeria as a investment destination, and we need to do more to demystify Nigeria. But Nigeria has been very good to us as well. And what I want to highlight is the very favorable and constructive fiscal regime that we have. Look, we like to talk about our advantage high netback production in Nigeria, and there are three pillars to that. One is, again, very high quality Miocene reservoirs, and this basically leads to low lifting costs. So we have very low operating costs of around $10 to $11 per barrel. We have premium Brent pricing. So, again, our production is medium to light gravity oil, and these are in high demand. And we rely on shuttle tankers, so we're not at the mercy of a single pipeline. So our marketing is very good, and we do achieve a premium Brent pricing. And as I've already mentioned, we have a very, very favorable fiscal regime in Nigeria. In fact, Nigeria is one of the few jurisdictions I know where the headline tax rate has gone down. So a few years ago, we would be paying a headline tax rate of 50%. We now pay corporate income tax rates of 30%. So all of those together has basically meant that our investment in Nigeria has been highly successful.
Is there incremental exploration opportunities on the blocks that you currently own interest in?
That's a very good question and a very good point, because I have fallen into a trap of talking to you about our great production, but I don't want the listeners and the viewers of this podcast to go away thinking it's just about production. In fact, on our license areas in Nigeria, we have development opportunities. So, for instance, we have a field called Preowei, which is an undeveloped field, and it's currently being progressed towards a final investment decision. Hopefully, we can have that next year. And as well as that, we have appraisal and exploration opportunities. We have communicated one of these opportunities on at the exploration end of the opportunity set as Akpo Far East, which is on a gross field basis around 140 million barrels of oil, which net to us would be around 20, so a significant price for us to go after. An important point there, Jeff, is that this is infrastructure-led exploration. Akpo Far East lies exploration success and a commercial discovery. It would be a fast track a development and a short cycle investment opportunity for us.
We can shift to the other parts of the asset base. In the Orange Basin offshore Namibia, Meren is exposed to high impact catalysts, including the Venus development project, through its 39.5% ownership stake in a privately held company called Impact Oil and Gas. After a farm down to TotalEnergies in November of 2024, Meren's net ownership in the Namibia blocks is about 3.75%. Shahin, can you just walk us through what impact the Venus development could have on Meren?
Well, look, we're very proud of our position in the Orange Basin, and this is an emerging basin that's getting a lot of attention in the international oil and gas industry and the markets. It is offshore Namibia and South Africa. So in Namibia, as you've already said, during first half of next year, potentially first oil in 2030. Now, this is a very, very large discovery. We haven't disclosed the numbers around reserves and so on. We expect that to be coming in the next few months. But an important aspect of this opportunity for us is that through a deal with TotalEnergies that we completed last year, all of the costs for impact share are carried by the operator, TotalEnergies. So on those Namibian blocks, all development, exploration, and appraisal activities, all costs will be carried through an interest-free loan. And now, this is a very important point, because I'm sure you've seen many companies our size who've had exploration success and then getting into trouble when they try and capture their resource through the monetization. So we have de-risked that. So in answer to your question, what does this mean for us? We have substantial production outlook from Namibia, and the first FPSO that we expect to have the FID, the final investment decision next year, is going to, on a gross field basis, is going to do 160,000 barrels of oil per day. So net to us would be around 5,000 to 6,000 barrels of oil per day, but that's just phase one. We expect that field development to get bigger. Important point here is getting to that point, to that first production offshore Namibia, isn't going to expose us to upfront capital expenditure. And the execution risk lies with our partners, operating partner TotalEnergies. So 2030 beyond, we have that production that is coming in, and it's supporting our longer term production outlook.
Shahin, as the operator works toward an FID, are there any near-term exploration ideas that they also are talking with you about?
Yes. So, look, the first discovery offshore Namibia was in 2022. There's been a string of discoveries since then on our blocks and other neighboring blocks, but there's still a lot more to be done. So, yes, look, we expect there will be further exploration activity on our Namibian blocks, and our interest, again, is through shareholding and impact oil and gas. But more importantly, most of the basin actually lies south of the maritime border in South Africa. And there we have a direct 18% interest in a very large block, which is at the heart of the basin. This is block 3B4B. And most of that block is covered in 3D seismic, and we have drill-ready targets. And we expect to be drilling on that in the next year to 2 years as well. We did a deal with TotalEnergies and QatarEnergy. That deal closed last year as well, where they will carry us on, and we expect that carry could see us through 1 to 2 exploration wells. So a lot of exploration activity to come in the Orange Basin, and it's not just about Namibia, it's also South Africa.
Shahin, you've talked about the farm down agreements with TotalEnergies in Namibia and with TotalEnergies and Qatar on your interests in South Africa. These are obviously very large companies that believe the resource potential justifies their involvement. I want to go back and hit on the notion that you talked about earlier about capital risk. How does Meren work with these larger companies to, one, work with them on advancing projects, but also how does the farm down arrangements protect shareholders and the balance sheet from future capital as you evaluate the upside?
It's a very important aspect of our business. I think in any business, selecting the right partners is imperative, but particularly in the oil and gas industry, you want to share the risk and the prize of high risk endeavors. And I think at Meren, we have demonstrated that we are very good at deal making, picking the right partners, but doing the deals at the right time. Really, the genesis of the company was exploration in East Africa. We had success, and we did the right deal at the right time with a company at that time was called Maersk E&P, which gave us the cash to go and buy these producing assets offshore Nigeria. So I think that the point I want to make here is that we are proud of that track record, because again, as a small independent, you need to know your limitations. Do not fall in love with your assets. Do the right deals at the right time. And also, look, in my career, I've seen many companies that have gone for size, maximizing reserves, production, without due consideration for shareholders. Shareholders, especially in today's capital markets, we have to, as a company, as an oil and gas company, we have to offer the right balance between growth opportunities and shareholder capital returns. An important part of that is, if you do have growth opportunities, make sure you've done the right deal. And we've done that in Namibia for the Venus development and the Namibian opportunity through that deal. In South Africa, we've done a farm down deal for the exploration on 3B4B. And we also have opportunities in Equatorial Guinea, where we are operating 2 blocks, and we will be looking to progress those through farm down deals with the right partners. Now, We have funded growth opportunities in Nigeria, in Namibia, and South Africa, either from cash flow from operations or through the deals we've done. And that has given us the flexibility and the optionality to pay dividends, to do share buybacks. And this is a very important point point of consideration if people are looking at our investment case, in that we have materially increased our base dividend policy after the Prime consolidation deal closed. So we used to distribute annually around $23 million per year. That's gone up to 100 million. And on a per share basis, that dividend distribution has almost tripled. And that is really the core of our business, is to get the right balance between offering our investors growth opportunities that more or less are funded and returning capital to them so that they're not waiting years and years for a big price to come in.
Just want to close on that point, Shahin. The notion that Meren is positioned to deliver material amounts of cash to shareholders from its existing assets over the next number of years, plus the company has fully funded upside exposure in some of these other areas. Is that really the crux of how you all think about running the company?
Yes, I mean that's what we are doing, and I think we are in a very good position. We have a rich opportunity set of organic opportunities. So I've already talked about development and infrastructure-led exploration in the heart of our portfolio, which is deepwater Nigeria. We have Namibia with the Venus development. We have funded exploration opportunity. Equatorial Guinea could become a big story for us next year. So these are all very good, and we are, adamant that, and we are confident we can continue to deliver on our dividend policy. There's also scope for supplementary dividends and or share buybacks, depending on business climate, oil price, and so on. But we also feel that we are in a good position, an advantaged position, to look at new business development opportunities. I mean, this may be a selfish thing to say, but maybe a period of low oil prices be good for us, because we are in a strong financial position, and maybe that would open up new inorganic opportunities for us to look to grow the business in a very disciplined manner. We're not going to run off to all corners of the planet looking for new reserves and production just for the sake of growing the company. Everything that we do has to be accretive. It's got to be accretive on valuation, cash flow per share, and it's got to be strategically sound. But I think that's maybe another part of the, if you're looking at Meren, maybe that is something for consideration as well. This is a well-balanced company that could also be a consolidator, a disciplined consolidator in the international E&P space.
Shahin, we look forward to drilling into some of those asset areas and projects in subsequent podcasts and fireside chats with you.
Thank you very much. Look forward to it.
Jeff, I liked your play on words with drill down. But thank you for joining us today, Shahin Amini, Head of Investor Relations and Communications for Meren Energy, TSX ticker symbol MER, and thanks to my equity research colleague, Jeff Robertson. And Shahin, I would be remiss if I didn't say I thought it was a brilliant statement you made earlier about the fact, don't fall in love with your assets, sell them at the right time, do the right deals at the right times.
It's not easy, but you've got to be disciplined and do it. Thank you so much, Jim. Great.
Thank you for listening, and don't forget to subscribe, as well as visiting www.watertowerresearch.com to stay up to speed on the company's small cap written research reports, podcasts, fireside chats, industry-specific symposiums, and conference schedules. We will see you next time for another edition of the WTR Small-Cap Spotlight podcast. Finally, a special thanks to the producer and editor of the podcast, Krista Fitzpatrick.